Welcome to another episode of Real Estate Investing Explained. Here's today's question. I know you have some metrics at the more macro level, so at the city level, and then you have some at the neighborhood level. Let's run through those starting at the macro level or the city level. What specifically are you looking for?
I'm going to walk you through all of those. So my first metrics is population growth. And at the moment, I'm looking for population growth between the year 2000 and the year 2017 to be around 21.5%. And given it's 2020, a lot of people ask me, well, why 2017? Well, firstly, cities don't change as often. So yes, you can go out and buy data for 2020. I assure you, you'll end up with the same set of cities. And secondly, the 2000 to 2017 information is very easily available on Google. So you can go to Google, type in for something like, Chattanooga population, and Google will give you a beautiful graph, and it'll have the 2000 and the 2017 numbers. The difference between those two numbers is over 21.5%. You're good. And what happens next year? Well, that number goes up. So population growth is that number one, the first out of the 5 metrics.
Why is population growth important, and why 21.5%?
So the honest answer is that when I did statistical analysis, I ran a bunch of scenarios. And what I found was at a certain point, above a certain percentage of growth, population growth was supporting a lot more rent growth. Population growth drives up rent growth. And we buy apartment properties because we're interested in rent growth. That's what we want. We want a high level of rent growth. And so to get that, you need competition. You need people fighting over the real estate. And people fight over the real estate when there's a lot more people. So for example, a place like Detroit, which has been losing population for the last 30 or 40 years, is going to have a lot less competition for those units and a lot more units available, right? Because it used to have a population that was, almost 2 million people 40, 50 years ago. So it's built a lot of those units already. So you want to go into an area where there's a lot of population growth because there's a lot of competition for your units. You want as many tenants for your units as possible. So I think, it makes an enormous difference. Why 21.5%? Well, the honest answer is I'm a statistical analysis guy. I've done the math. What I find is today, above that level, you'll see a high level of competition with people fighting over your unit. Below that, that competition is slowly going to start falling away. Now, I'm not saying that don't go into a city if it's at 20% instead of 21.5. That's not the point. My point is that if you're looking at 2 cities and one of them is over 21.5% and the other one is at 17, you know which one to make.
So how about the second metric? What's the second one that you look at?
So the second metric is income. So I want the income levels to be increasing in that metro by about 32%. And you get this information at city-data.com. So, for any city in the US, type in the name of the city. And you scroll down about 12 inches and it'll show you median household income. And you'll notice it gives you 2 numbers already. In this case, for the second metric, the number is about 32%. So you want the income growth over between 2000 and 2017, between those 2 benchmark years, to be at least 32% or higher. And once again, the Excel spreadsheet that I give you tells you what should the number be next year? What should it be the year after? So you can keep using this system. The whole point is that I want to make sure that people are not paying for the system. It is meant to be free, completely free. No one should ever charge anything for it. So bottom line, because I'm giving it away for free, the system tells you how to use it next year and the year after and the year after. But in 2020, about a 32% increase in income. Why increase in income? I think that one's pretty common sense, right? You want to increase rents. Well, if their income remains the same, how can you increase rents on people that are not making more money?
Yeah, I mean, if their income isn't going up, you can't increase the rents. Otherwise, they're not going to be able to afford it.
You can try and increasing rents. 2 things will happen. One is you'll either end up with a lot of vacancy, or second, they'll end up staying, then they won't have money, and you'll end up with lots of delinquency. Both of those are really bad scenarios. In fact, delinquency is even worse than vacancy because you have the unit's not available for you to re-rent, but you're not getting paid for it. So that's a really, really bad scenario. And then number 3 is home price growth. Now, even though I'm an apartment guy and I buy large apartment complexes, I find that this system still works because I want home price growth in a city that I'm buying apartments in. Because you know what home price growth is doing, Robert? What it's doing is it's preventing people from buying homes. As the prices go up, every single time you have home prices going up, there's some people at the margins that just had enough money to buy a home and now they're outbid because the home price went up. And those people are actually the best tenants because they wanted a home. They were gathering money, they had down payment, and it's just the prices went up a little bit too far for them and now they can't do it. And guess what? They're going to go into the best apartment unit that they can find. So as I buy apartment properties and I rehab my units, well, those are the tenants that I want. And I can't get enough of those tenants if the home price in the city doesn't keep going up. I constantly need the prices to be inching up a little bit. So there's always these people at the margin falling out and becoming long-term tenants because they can't afford to buy the home prices because of the price increase. So in this case, we're looking for about 41, 42%. And so about 42% of an increase, once again, in that 2000 to 2017 timeframe. And where do I find the numbers? Same website, city-data.com, type in name of your city, scroll down about 12 or 13 inches. And right there, you'll notice median house or condo value. You'll see two numbers. There's going to be a 2000 number. There's going to be a 2017 number. Your goal is not to get 5 thumbs up. Your goal is to get as many thumbs up as possible for cities that work for you. So what I highly recommend you don't do is, if you live in Seattle, don't start plugging in cities that are 2 hours away from Orlando, because you're not going to fly out there often enough. You're not going to check enough properties out. You're just going to buy the first one that comes to mind. So what I'd much rather do is, instead of 5 stars on a city that's 3,000 miles away, I'd like to get 4 thumbs up on a city that is 200 miles away. Because you're going to manage it better. You're going to spend more time flying out there. You're going to check out more properties before you buy one. So the system is not some magic bullet. You have to use it with a lot of common sense. And so that is the third metric.
I like your rationale behind that third metric, because I've heard you explain that to me a couple times, but the first time I heard you say that, I remember thinking that you had that metric because you wanted the value of your properties, or even the apartments you're buying, to increase in value to take advantage of appreciation. But really, it's not necessarily that. You're really looking for those tenants that are just priced out.
I want tenant competition, and I want the best quality of tenants. And the best quality of tenants come in markets where there's consistently a creation of new high quality tenants, right? So it works really well. So metric number 4 is about crime. And once again, it's city-data.com. Scroll down, you'll, on the same page where you were checking out all the other numbers, there's a blue table. Ignore the entire table. The bottom line is blue in color. So it's the only line in the table that's blue in color, and it's called the City Data Crime Index. And what you want to do is, the latest year available, which is 2018, not 2017 for crime, you want that number to be lower than 500. So if the city that you're investing in, the crime levels are lower than 500, then you're less likely to have delinquency and all kinds of other issues that come with high crime. And also, you want to look at it from the left to the right and see if crime is decreasing. You want to see a smooth reduction in crime. What I found is nothing is as correlated to an increase in home prices as a smooth reduction in crime. So if you're in a city where that crime is reducing and it's below 500 for the most recent year, then you have a much greater chance of home price appreciation or apartment appreciation.
What does that 500 number represent?
It's an index. So that it represents nothing in particular, but it's an index. And what I found is, below 500, cities tend to have cap rates compress, which pulls up prices. And obviously that's great for you as a real estate investor. But if the crime's higher than that, then it tends not to have as much of a positive effect on home pricing. And you want that positive effect on home pricing.
And how about your 5th metric?
The 5th metric is my favorite, and it's jobs. So jobs matter only in the short term. So I don't have a metric that looks at jobs for the last 17 years or the last 10 years or the last 5 years. I only look at jobs for the last 12 months. And that information is on a separate website, and perhaps we can give that to your podcast listeners through a link. It's www.deptofnumbers.com/employment/metros. So the Department of Numbers.com, which is a government website, basically gives you immediate last 12 months job numbers. And this is a page that has pretty much every major city in the US listed, even some smaller ones are listed. And the column at the far right shows you the 12-month change in jobs. So obviously, because of the coronavirus, this coming month, pretty much every city in the United States is going to be negative. But in normal times, most cities are positive. And what you want to do is you want to sort by that column, and you want to go to a city that has high job growth in the last 12 months, because there's a lot of competition there's a lot of job growth. There's a lot of competition for units because people that were living with mom and dad are now moving out. They're establishing households. The more households you get, the more competition for your unit, for your rental units. So bottom line is 2% job growth is decent. 3%, you're really, really happy. 4% job growth, you're basically buying champagne bottles. 5% job growth, you're dancing naked in the street with your champagne bottle. That's how good job growth is. So try and stay above 3%. If you're in a major metro, 2.5%, that's pretty good. Try and stay above 3%. At 4%, you're going to be able to raise rent practically at a crazy level.
So when we talk about all these metrics, and you mentioned that job growth is your favorite, do you look at them on a weighted basis, if you will? Because you mentioned that you don't have to have all 5 stars. So what if you have 2 or 3 cities that might have 3 stars or 4 stars, and now you're comparing the two, but one is, just the population's growing, but the job growth is actually slow or declining, where you have another city where its job growth is growing like crazy, but population isn't as great. How do you weigh those types of metrics?
So I haven't released a version of the system that weighs those metrics. For those of you that are good with Excel, you can weigh my metrics by giving 15, 15, 15, and 15% weightage to the first 4 metrics and 40% weightage to the jobs. So 15, 15, 15, 15, and 40% weightage would be appropriate.
Wow. I've done the actual weighting myself in Excel. I've used your spreadsheet. I did not use that specific spread. I didn't know that the job growth was that important or that heavily weighted.
Job growth means money. I mean, it is the most direct way that people get money in their hands. So it makes an incredible difference. So I think that there's nothing like it. You'll see it this month, obviously. We had a super powerful economy in February, and today we don't have much of an economy left, right? We are in a complete, orderly, sustained shutdown of the US economy, and we'll start it back up sometime in May. So it's crazy, but it shows how important jobs are.
Yeah, absolutely. I'll be sure to put links to all the different resources that Neal mentioned, and of course his website in the show notes. So everybody listening today, you don't have to memorize it or write it down right now. You can go in the show notes. Everything will be there. I also wanted to mention that I put together an entirely free resource or platform that allows you to use these metrics that Neal is talking about. It allows you to filter them. I follow Neal's strategy very closely. And for me, I got kind of sick of going through every single city individually to try and find a good one, because it doesn't allow you to filter through the cities. So you had to go through a lot to find a good one. So what I decided to do was there had to be a better way. And so what I did was I created a mechanism or a platform that allows you to filter based on these metrics. And it has all the same data. So you're able to find that. So if you're interested in that as well, you can find that in the show notes. And of course, it's 100% free. That's all for this episode of Real Estate Investing Explained. Be sure to follow me on Instagram, Twitter, and Facebook, or subscribe to our YouTube channel to get even more free content.